Now we want to look a bit more at the U.S. Again and go a bit deeper into some of those leading indicators. But we first wanted to, again, set that stage looking at employment, because household survey, as we said before, moved up in January, which was the strongest gain since January of 2022. And remember, January is always a lumpy month, just because of the data sets, the different movements in temp versus other. But it's still a good number. And as we said before in the previous segment, household is catching up with the underlying payrolls. And it's just, again, as we said, that meet in the middle. But now when we start looking at, again, that average hourly earnings, you can see that it was up 4.4% versus the estimate of 4.3%. But there's an uptick in job cut announcements, but it's still at odds with the initial jobless claims. And one of the things that's really important is just because they've been announced doesn't mean that those individuals are looking for work. You may have gotten a healthy package. You may have gotten some several months, so you're taking some time off. And that's, again, slowing. So as those individuals come back into the market, that should be fairly good for some of that participation rate, which as the participation rate goes up, it means that people are seeking jobs, which is going to actually increase the unemployment rate. So that, which is not a terrible thing when you consider some of these different levels and what is going to trigger the Fed to stop raising rates or pause. And that's, I think, the employment. But this is going to be something to watch and to look at. Now, core factory orders growth continues to slow with year-on-year rate down to 4%. It's still healthy off the peak, but it's important to look at, well, what was the driver? So December factory orders was up 1.8% versus the estimate of 2.3%. Orders ex transport, though, was down 1.2% versus the estimate of 0.2%. So you're starting to see that slowdown, which is manufacturing, which comes back to imports, which comes back to the international trade side, which is why we see that trade moving down. And the problem with where this is, and no matter how you shake it, the U.S. is the largest economy in the world, the largest buyer in the world. So if the consumer's slowing, inventories are building, you're not importing final goods. Now you're looking at manufacturing with PMI coming negative, new orders steeply in contraction. Well, the manufacturer is not ordering new stuff either. So on both sides, you're seeing this pull down on economic growth and activity, which again reverberates back into the export market and hits other markets, especially countries like China and other emerging entities. U.S. factory orders excluding transportation, you get an idea that this is now another month. But looking back the last few months, it's been either flat or down. So you're seeing that perpetual move, which is one of the things we were calling out as we came into the new year, because January was a bit stronger than we expected on imports, on trucking activity, but now you're starting to see February really catch up, and some of the regional data is showing some of those pressure points, with Chicago, again, expected to be at 45 and instead coming in at 44.3, moving in the wrong direction, but as we said, kind of bouncing along the bottom, not nosediving to 30 like we did in 2020, but again, kind of bouncing along. And you saw in 2019, as we've been saying, 2019 was not a good year, especially the second half of 2019. So when you look at some of the pressure points and when things are actually worse than pre-COVID, you're not talking about a particularly strong period in economic data sets or a point in time, which I think sometimes gets forgotten just given how painful COVID was. So then the clear disinflationary movement is building, which, as we've saying, is what we believe. Disinflation is going to happen on the 1 month, 6 month, 1 year Dallas Fed trim mean. It's all moving in that direction. We just think that the pace of it slows, and that's where you get some of these pressure points coming back to what we talked about in segment 1 with food and other inflation. And then in segment 2, looking at service inflation and how that's going to hit hard, mixed with, again, that unit cost of production also being elevated. Inflation expectations are falling fast. 6-month change in expectations for inflation are 1 year out as most negative since 2011. So people are starting to see or expecting inflation to fall fast, but that's actually changing as well. When you look at January, gasoline prices went up 16, 17%, and you're seeing some of those increases, which again is going to put pressure on the consumer and underlying activity. So then when you look at one way to capture it, the deceleration in economic growth is a trend for real final sales to private domestic purchasers, which barely expanded in Q4, only coming in at 0.2. So then when you look at inventory rebuilding swung higher at the end of 2022, given that 1.5% contribution to real GDP. So the underlying movement that shows you where activity is going, are we accelerating and decelerating, was showing deceleration. But as we said last year in 2020 through 2022, inventories are lumpy and they're going to be a positive contribution and a negative contribution depending on weightings, and inventory was a positive contribution. But that also points to a slower consumer, a caught up inventory piece where people just won't spend the same way, and companies don't have to buy because they have inventory to work through. So the key to watch moving forward is the Fed's preferred subset, which is the core PC services X housing. And as of December, it was at 4.1% year on year, which is still way too high given where they want to be. And especially when you go back through 2001, even though it's off the highs, it's still excessive given where we need to be. Again, leading to why we're not going to get this big Fed pivot. Government transfer payments, share of personal income ticks slightly up, but way off the peak. Then when you look at average hourly earnings, it's coming down, but the savings are boosting the consumer demand. That's the view. But look at where personal savings are and then think about how it's been disseminated across people. This most recent Fed experiment created the biggest growth in income inequality in our, at least recorded history, if you want to say going back 150 years, because I'm not going to talk about the French proletariat and how that, if that's equivalent. Realistically, this is just a massive shift in income breakdowns. So when you look at the draw on excess savings, it really started to accelerate earlier. And the question is, and as we showed the inflation side and the stickiness, especially when you look at how inflation continues to go up for everyday items that people purchase, that is the underlying problem where we think that the draw on excess savings started sooner and is happening much faster, which is again drawing down on that, retail sales. Personal income, wage and salary growth has cooled, but 6-month annualized growth rate still hovering at about 5.7%. Savings rate has ticked up slightly, but at 3.4% is still one of the lowest in history. So then when you look at PC inflation for December coming in at 0.1 versus the estimate of 0, core stronger coming in at 0.3. This is what we've been talking about, where core is going to outpace headline. And even though headline, you might get a negative 0.1, negative 0.2, core is not going to go negative. And that's going to be the problem that is also, again, showing itself in what we've talked about regarding the pressure points in the different areas of spending and discretionary income. So the personal income coming in at 0.2 versus the estimate of 0.2, prior month at 0.3, revised down from 0.4. Spending coming in at negative 0.2 versus the estimate of negative 0.1. And then there was revised down from a positive to a negative. Again, the revisions are coming down. The spending is coming down. All of this is showing, again, the direction in which the economy is heading. December PC inflation at 5% versus the estimate of 5% year on year. Core coming in right along. But again, it rolls, but it doesn't fall. Like we're rolling down. It's coming down. But as we showed previously, the last 3 segments, we see a lot of this normalizing at these levels with real personal consumption. Again, durable goods will keep coming down. We see services still taking some market share. So one of the key components is we don't expect this massive decline. That is the misnomer where everyone's like, oh, Mark, everything you're saying is so doom and gloom. We are not expecting this implosion. It's just manufacturing non-durable goods. Durable goods is going to come down. Services will take a bigger piece, and then they'll come down together. But we do expect durable goods, non-durable goods, to come further negative as services also pare back. But when you look at the labor share of income, and you look at the last 2 decades, you're seeing the pressure in the amount of income the labor side is getting. And that is, again, creating more of that pressure when you look at income, when you look at the different pieces. So when you just look at the underlying pressure points on income and share, that's a problem, because as the vertical line here shows when the China entered the WTO. So when China came in, it was much easier now to go to China. And not to say that it wasn't happening from the 60s and 60s, 70s, 80s, because it was, but now it made it easier. And now you had a resurgence of stuff going to China, which brought down the amount of income that was going to the labor force, shrinking that middle class pool, shrinking the amount of money they have available as inflation has been clipping along and income hasn't been able to keep pace. So then now when we turn to homes for a minute, there was a bit of a bounce for December pending home sales, coming in at up 2.5% month on month versus the estimate of -1%. But again, still under pressure. Jump was largest since October, but overall you can see just how low it is. And then the building cost index has continued to drift higher while inventories of product is increasing. So at some point you're going to get this pivot, and we think the pivot is going to happen sooner rather than later in terms of some of the cost coming down. Year-on-year growth in median price of new single-family homes has come down sharply, but at 7.8%, it's still quite strong relative to history. So again, that's where more of that impetus to see some of that strength continuing on the inflation front. Rise in auto delinquencies. The percentage of borrowers at least 60 days late on their car payment is rising and approaching now above where we were in 2009. And that's, again, just showing some of the weakness in the underlying consumer and their spending. And then the HPI forecast percentage change year over year. They still see growth in underlying home prices, which again is going to be a problem when you consider inflation, where the Fed would like to see asset prices. But again, that's going to take time, especially when you look at the new home inventory still remains under construction. So you still need to see that those completions come through. New home sales by price continues. The starter home, if you will, doesn't exist anymore. Everything is now pricing higher, with the median being in the upper 400,000, lower 500,000 level, which is a very tough spot to try to start a home because you have to get the down payment. Mortgage rates are over 6%. The cost of doing it is much easier, is much harder. And again, some of those underlying problems and pressure points. Inventories of construction materials are piling up, with this chart showing the wholesale inventory to sales ratio. And business lending standards and equipment investment continue to diminish. So again, showing that CapEx slowdown, and showing, again, that slowdown of activity, which is creating some of these buildups in equipment, in raw materials that are not only for equipment, but also the raw materials going into homes. And it's, when does that pivot? And as that pivots, you'll see some of those prices come down, which will also help drive down some of those asset prices. But this is going to be an interesting one to watch, because when you look at weakness in temp tends to lead the overall employment. So temp hiring has slowed. And typically as that happens, you normally start to see a bit of a pivot. So February is going to be really important to see, was January more of an anomaly and things are really slowing, or are we going to see some of this continuation? I think the jury's still out. I would expect to see February get worse than January, but still be fairly strong. And that's because of the inner workings of participation rate, retirements, which is going to keep things a bit aggressive. Real inventories expected to be retail inventory, expected to be up 0.2, came in up 0.5. And then real inventory, when you look at it based on price, adjusted for inflation, you still have inventories coming back to pre-pandemic levels, which again just shows things are normalizing, slowdown in buying. We won't get that same type of increase in that bump on the GDP front, and also showing that slowdown on the consumer. PC inflation, durable goods up 1.4%, still seeing that elevate. But remember, it's coming down. But look at services. Services came down, but it's still just slightly off a record. So when you look at activity, services continues to be the biggest driver. That is the where the biggest stickiness is going to sit on those inflationary numbers, which is why U.S. real personal consumption came in below estimates. Still above trend, which is a positive, but we see that accelerating now to the downside. You've already kind of pivoted. You've already started the downward trajectory, and we see that accelerating, which is then going to go below trend and put more pressure on the economy. And the reason why is when you look at, again, durable goods, non-durable goods is going to be the biggest driver of that as services stays fairly flat, but that's also going to support service inflation, which is an underlying problem with U.S. consumer spending may face headwinds into Q1, which again, we continue to see as the base case. U.S. disposable personal income flatlining as we see savings bouncing just a touch. But then when you look at retail daily net inflows, people are still very positive the economy, and retail investors continuing to be net buyers. There's still no fear in the market. There's still a belief that the Fed will pivot, that there's, and until we have people feeling real pain, it's unlikely we're going to see that pivot. And then when you look at some of the leading indicators, Kansas City Fed manufacturing expected to be at -8, came in at -1, slightly better, but still contracting. Manufacturing new orders came in at -8. So again, new orders, leading indicators, still showing some additional pressure points and some additional problems. Kansas City Fed manufacturing coming way down at -8. But then when manufacturing expected number of employees bouncing. So there's kind of this dynamic of which one's going to carry greater than the other. And that's going to be an interesting one to watch in general. Kansas City Fed Service Index came in at -11. Expected revenue on the service side came in at -7. So here you're seeing services, come down further. That, which is an important data point, and kind of goes against what we've been saying on services. But again, this is one data point and it's something to watch because this could blow a hole in our view of services. Some of the other Fed data supports us. So it's going to be interesting to see, is this just a near-term blip and we'll get a bounce? That's why we would like to look at these things every week, every month as they come out to see, do we have to change our view? Is something shifting? If services comes down faster, that'll slow down some of that inflation that we expect. And those are the key important pieces to watch for as we do gut checks on what our views are of the world. CoreLogic Schiller Composite home prices expected to be at -0.7, came in at -0.5. And then year on year was expected to be at 6.8%, came in at 6.7. So again, still some of that impetus to drive, again, just higher home prices coming down, but not enough to really adjust the inflation story as it lags. So we still have that inflationary backdrop. That's what we have for you here. In the next segment, we're going to go deeper into Europe and some of the new data sets that, again, kind of give us pause on some of the things that are happening on the economic front.